everyone. I'm Michael Carney, and thrilled to be here on stage today with this particularly distinguished group of gentlemen. They really are the ones who have summited the mountain and gotten to the place that a lot of us in this room are aspiring to get to. They're CEOs of formerly venture-backed, now public companies, and there's only a very small handful here in LA, and I did some research before we came here today. Only 1,000 or less than 1,000 in history anywhere in the world. So it's a very, very elite group. And we're going to talk a little bit about what it means to be a public company CEO. Before we dive in, would you guys start by just introducing yourselves briefly and a quick word about your companies?
Sure. I'm Scott Painter. I'm the founder and CEO of TrueCar. We're based in Santa Monica. We've been around for about 9 years, and we're venture-backed by Upfront and Anthem Ventures here locally.
Adam Miller. I'm the founder and CEO of Cornerstone OnDemand. We went public about 4 years ago. We help companies to recruit, train, and manage their people, and today have 17 million users in 191 countries using the system in 42 languages.
Hi, I'm Hemi Zucker, employee number 1 with J2 Global. Took it public in '99, joined the company in '96. We are 1,500 employees in Hollywood with offices in 14, 15 countries. And we have a division of cloud services, which is $500 million a year, a division of cloud media, $200 million a year revenue.
I mentioned a pretty elite group. We've been hearing the term unicorn thrown around lately. Typically refers to private market valuations of $1 billion. All three of your companies are worth over $1 billion today in the public markets, about $4.95 billion in value. So, quite an impressive group of three companies here. Let's talk a little bit about the earlier days of each of your companies. Before you got to this stage, was a public exit always the end goal? Did you have that in mind, and did you do anything along the way to prepare for that, or was it an unintentional result maybe of just building a great company? How did you guys think about that?
I guess I'll start. It's like the dating game. As a venture-backed company, I think you have an obligation to repay the money that comes into the business. And I know that the folks who co-founded the business with me, we always viewed that the money coming into the business was a loan. I think when you take venture dollars, you have an obligation to return and repay that loan. And so going public was, I think, an eventual thing for us. We've always acted as though that was our destiny, and I think that we've operated with a certain amount of discipline and rigor even from early on. And so, organizing that way, I think, set us up for that. We've also been sort of very, very focused on senior talent and folks who've been in public environments before, and that tends to, I think, give you a more mature shareholder base as well. We've raised money all the way along, and so as you continue to raise money, you have to sort of go up and to the right in terms of valuation, and you have to get more public-like investors as you go along. And so I just think there's an eventuality to it. If you're fundraising and you're growing and the business is a hyper-growth business, you're going to continue to be investing in the company. It's a pretty logical conclusion if you're not going to get acquired along the way.
It's a slightly different story. So we were bootstrapped for about 7 years. So we had only angel investment up till then. One of our angel investors is actually here, John Frankel. And we, from the very beginning, thought we would someday take the company public. So I had that objective literally day one of the business.
Ring the bell?
To ring the bell someday. I actually pushed the buzzer. There is no bell at the NASDAQ, I found out. But it makes a bell-like sound, so it's very similar. And always had aspired to do that, so all along we kept building the company to last. So we always had this goal of making the company built to last, meaning we weren't going to take shortcuts, we weren't going to try to do something quick to flip the company. We would make long-term decisions and stick by it. But even up till the point we went public, we didn't have a single person on the team that actually had any idea what that meant or how to do it. And that's still true today.
So I joined my company as a CFO. My goal was to raise money, the initial funds. We actually went in '99 because we were rushed into it. We knew that it's, the bubble. We went public at $9.50. A year plus later, we were 23 cents. So for those of you who rush, be careful. And then we climbed up again till 60. We've done several funding deals. We did a bond in 2013. Just to illustrate, I worked as CFO 8 months to raise $80 million. I worked, 10 million yield per month. For the bond, I worked 2.5 days, so the yield is, for $250, $100 million a day. And recently, when we did the convert, I worked half a day for $400 million. So it's much easier to raise money. Another reason to go public is the ease of raising money when you have the platform. Being a public company is not a goal, it's a platform.
I can beat you on that. 7 years to raise $4 million. And then I think it was literally 2 hours to raise $250 million in the convert.
Amazing.
I think raising money sucks.
Yeah.
It doesn't matter
Because you have
how
to
much
give it
and when.
back. You have to give it back. Yeah.
That's a good transition. Let's start with why a company should want to be public. And there's a lot of reasons, and they're not always the same for every company. But if you're a, let's say, Series A stage company, and you're trying to think about where this all goes, whether you should be positioning yourself for an exit by acquisition, or whether you should try to stay independent, what's the upside of being a public company in this era? If you were to go public, let's say in 2015 or 16.
So for us, it was very specific as to leaving aside sort of my ambition to do it from the beginning. For the company, it became very much a commercial reason to do it. So we were competing against 2 public companies. They were competing against us. We do enterprise software, so we were competing as a cloud company against other cloud companies that were using corporate viability as a main way of competing. So we had a much smaller balance sheet. We weren't public. They were. And it actually caused us to lose some deals. So going public solved that corporate viability issue, got us a very strong balance sheet, and increased the marketing of the company to our target market.
I would say that the things I learn most come out during financings. When you're raising money, you get challenged by really smart people. It doesn't matter whether you're at the very beginning or you're talking to public shareholders. And I think the process of going public is a really good maturation process for a management team, for a CEO, for a company. I think our company is much more rugged and durable because we've gone public. We've also survived a boycott, so I think there's a certain element to sort of surviving an apocalyptic scenario where, as a company, we're very, very stable. I think that being public, though, holds us to a standard in terms of how we operate, and we have to set expectations, and we have to meet those expectations, and it's very real. But I think it makes us a better company. I think it forces us to be very disciplined. There are infuriating things about being public. There are great things about being public. I think the impact on your employees is both just fantastic, and then it's also, people are neurotic about the stock, and if it goes down, you get people who are just very, very upset and hard to motivate. And that casino capitalism is not a positive thing. I think that, as a newly public company, that's one of the things that I'm trying to work against. But we do have access to capital. We do have a currency. We do have the ability to talk to partners. For us, we also were fighting for validation in an industry that really wanted us gone. And so becoming public...
Meaning the dealers, right?
The dealers and the auto industry. I think that, broadly, manufacturers, dealers, all sort of are part of that fabric. And we were a very, very disruptive force. And I think that becoming public, I heard a dealer say, you guys sort of won. And whether that's true or not, I certainly don't think we won. And I think going public, by the way, is not summiting anything. I think it's not really a finish line of any kind. It is literally a starting line. For us and for me as an entrepreneur, you fight for money, you fight for validation, you fight for credibility, momentum. That's what we have now as a public company. And it's fascinating to have been in the venture world for so long, where everybody's looking for that 10-bagger, and yet we're a public company and we're a 10-bagger. I mean, we are just getting started, and we have had to spend so much of our time, energy, and resources over the last decade on raising enough money to survive to the next thing, right, and making so many survival-related decisions that this is the first time that we've actually been able to say, you know what, we know how the business is going to look for the next 4 quarters. We're very disciplined about how we operate. We can reliably and predictably forecast the business and where it's going to go and how it's going to grow, and invest without spending half of our time out fundraising.
I noted that your stock's up 75% 5-ish% since May, since you went public. Does that sound right?
It's doubled. So we came out at 9. It's funny. We came out well below our range, and I was pissed. I think it was awful, and yet it turns out to be a great thing because the company looks great. We were the second best performing tech IPO of 2014. We've gone as high as 25. So to go out at 9 and then peak up to 25, I think is exciting for folks. I don't really care, though. I mean, at the end of the day, I'm buying stock and I'm not selling stock. Right. And I don't think that anybody who knows anything about the business is a seller. Right. I mean, we've just got a huge market in front of us, and we're just getting started.
You mentioned something I think is interesting. You said we have a currency, which means you can use your stock to make acquisitions. Hemi, you mentioned something to me yesterday, which blew my mind. You guys completed 29 acquisitions last year. I guess that makes you third in the tech world behind Google and Yahoo. And you don't own part of Alibaba, right? So tell us about that strategy. How did you guys become such a prolific acquirer?
So, we went public, and we, as I said, there were good days and bad days. Now that the good days are here because we're extremely profitable with EBITDA reaching almost 50%. You generate a lot of cash. And one of the ways to use cash is to acquire market share in businesses. It takes time, discipline. But over the years, we became very good in it. I mean, the muscle that we developed is the M&A muscle. It's not for everybody. And we're just doing it over the years, and we accelerate in our acquisitions. And we are very ambitious, and now we are sitting on public companies. So I said the last quarter was $700 million of cash, and the motivation now is to put it to use.
Right. So at least for now, let's say that's the positive side of being a public company. Let's talk about the other side. There's a lot of conversation right now in the venture world in Silicon Valley, let's say, about staying private as long as possible. I think we can see it in the data that companies are waiting longer to go public. When they do go public, they're going public at much higher valuations. That was the case in the past. Talk about the challenges of being a public company. Obviously, transparency, reporting is a big one. And what do you think when you hear an entrepreneur who is still private, is on a company that looks like it might have the opportunity to go public, say, listen, I don't want to do that at all. I'm going to stay private as long as possible. What is your reaction? What is your advice?
I'll take it. So being a public company is like under the magnifying glass, meaning if you're doing well, everybody sees it. If you're doing not so good, under the magnifying glass. So in my opinion, the advice that I give entrepreneurs is indeed to delay, not to rush into it. There were days that J2, the stock was on the teens, and I had all these private equities coming around, and I kind of regretted I didn't do it. Well, I could have taken it private and, at the teens, and now we're at 60. So I think that it's a platform. Being public is a platform, and there are advantages and disadvantages. The disadvantages are that you cannot plan for long term. Being a matured company, I no longer look at the stock price. We have employees that over the years, there's less options and less shareholders among our employee bodies. A matured company, a public company that has been around with market cap above, and I don't want to call it now, but my life changed when we went above $2 billion and stabilized there. My colleagues probably have some other views on it. Today, I really think that we are enjoying being a public company, but it was not an easy way to get there, basically. So my advice is don't rush. Going public is only one of the exits. There are much better exits with, selling the company, and nothing is wrong with owning it. Just keep it private.
I think it partially depends on what is the commercial reason for going public. Does it help your company or not help your company? There's factors like how do your employees feel about being private versus being public. You mentioned being public's not an exit. We thought of being public as a graduation. So for us, our IPO was a graduation. We treated it like a graduation party. And like a graduation from high school or college or grad school, you then have the rest of your life. So is that really the end? No, it's the start of the next chapter of your life. And so for us, it very much was a huge milestone for the company, a huge motivator. And after it, we matured and dealt with things of being a public company. So for us, it was great for the first 2.5 years. We were up 400% from the IPO. Then multiples compressed in our space. We got hit as part of that. We went down a lot. You have issues with employees concerned about stock up, stock down, and you have to deal with analysts, you have to deal with the press, you have to deal with a lot of speculation that's happening outside your control. But you also get the benefit of having a currency, having better market awareness, and having a liquid asset for not only other companies, but your employees as well.
Right.
Also, I want to add, it's easier to do hostile on public companies than on private.
Right.
Which is another thing we have to live with, you know?
Yeah, I think the advice about whether to go public does depend on whether you're ready. You've got to be able to forecast your business. If your business is not predictable, you shouldn't be public. You really have to be able to signal that and deliver. The second thing is you need to be a growth company. If you're not a growth company, stay private. I think generally the advice for entrepreneurs should be, the talk track is we're going to stay private as long as we can. I think it's a horrible trap to get sucked into the PR conversation of I want to go public,
right.
And because that's almost always the cart before the horse, and it just means that the business has the wrong priorities.
Each of you have mentioned in one way or another the short-term perspective that Wall Street takes when looking at businesses. Being technology-based business, we're always taught to think about innovation and moving quickly and coming up with the next great thing. How do you balance doing that in an environment where your shareholders and the microscope is looking at, are you going to meet your numbers 90 days from now? How do you swing big and keep that momentum and be a growth stock, as you mentioned?
You've really got to play two games at once. You have to play the short game and the long game. So you have to play for the quarter because that's what Wall Street's going to look at. But if you're not investing 2-3 years out today, then by the time you get there, you're not going to be able to play that short game.
Yeah, I think as well there are two very, very different things going on at TrueCar. One is about delivering. And you've got to be a fundamentals-based company. You've got to deliver on the results. You've got to deliver on the quarterly expectations. You've got to hit your revenue and your margin beats. And I think that the side of the business that focuses on that can't run the whole show. In our business, there are lots of decisions that get made as the quarter comes to a close that are very short-term thinking in nature. And I'm learning that we have to really resist that. We have to resist the temptation to say we're going to make short-term decisions because that mortgages the vision of the business. And so I think this is, in particular, this is where a founder-driven company has extraordinary value because I'm not going to sacrifice the long-term vision that we have for the business for the short-term benefit. And that doesn't mean that I'm not focused on delivering on the short-term set of expectations. We really do well there, and we wouldn't be public if we couldn't. But I think that as a business, the people who are at TrueCar are driven by a higher purpose. They believe in the integrity of what we're doing and that truth is a more profitable business model for selling cars and selling anything. And they're inspired by that vision, and we don't mortgage that.
Adam, you mentioned that you're on the NASDAQ. I'm not sure which of the two exchanges you guys are
NASDAQ.
Each on.
NASDAQ.
One of the things, so all three NASDAQ, interesting. One of the things we followed recently, kind of precipitated by the Facebook IPO, which didn't go great, was a big shift in Silicon Valley and tech companies from all over the world going public on the NYSE rather than the NASDAQ, which was certainly not the trend for the 10 or 15 years before that. Does that matter, in your mind? Do you think it's even worth considering at this point? Just get out there and be public and
Totally irrelevant.
I think one of them is less expensive. I don't remember whom. But besides, I think.
Yeah.
It depended on what your market cap was.
Right.
One was cheaper when you were small and more expensive
Exactly.
when you get big.
Thank you. That's it.
So I mentioned when we first sat down here that you guys are among a very elite group, not only globally, but also here in LA, public company CEOs. We're all here talking about the growth and the maturation of the LA tech ecosystem. How important is it, do you think, that we have public companies rather than just big, successful companies? Do we need more IPOs? Is that, from an optics point of view or from a practical point of view, is that important?
It definitely helps. I mean, for starters, some of the private transactions aren't disclosed, so people don't necessarily know how big they are or what the returns were. The IPOs are very well tracked. They're easy to see from the outside world. And when we went public back in 2011, there was a spate of IPOs in LA, and I think that was part of what's helped this curve of more capital being infused into LA, more people willing to take the flight from the Valley to LA or from Boston to LA for the board meeting. and a greater willingness of people to look beyond the local market, which typically was in the Bay, into other markets. So not just LA, but Salt Lake City, Seattle, and the like.
Yeah, I think being a public company, factually speaking, is just a reflection of more maturity and more discipline. And that's a good thing, right? And so I think if you are trying to recruit talent, even though TrueCar is trying to recruit talent, the more talent that comes to LA, the better it is for us. It's a better talent pool. And so I think that it is important that more companies get public. I think it's been hard for the last 5 or 6 years to get public. And I think that it's harder than ever to be a public company. I actually enjoy it. I mean, I think it's much nicer being a public company CEO than a private company CEO, because there's actually rules of engagement between the shareholders and management. And as a VC-backed company, you're in hand-to-hand combat every day building your company, and there's a lot that goes on in getting to a place like where TrueCar is. And I think that it's refreshing to be able to wake up in the morning and know that everybody's focused on the same things, that we know how to manage our story, that we report on a quarterly basis, that we can set expectations, that there's sort of a bit of a pattern to what we do, which is very, very helpful in certainly hyper-growth companies.
I really enjoy it, so as being acquisitive, public companies are also a reflection of your real values. So we bought several public companies that if they were private, we would never had the opportunity. Our first acquisition was a public company called Efax, and then we did more. Now, in reflection to the LA, yes, I think that it brings to LA a lot of advantages, including the fact that some of your employees, they really have an exit when you go public, much harder when you keep them private. So they make an exit, and the entrepreneur, give you an example, the CEO of Lyft is an ex-employee of J2. It's one of them. So it's not only giving money to the shareholders, also some employees are entrepreneurial, they get cash, they go and they come here and sit in the audience. So it's good.
The trickle-down economics. Yeah.
Absolutely. And as I said, it's an acquisitive company. Some companies go public and they shouldn't. Right. So the markets are telling them, look, here's your valuation, and it's much easier to acquire them and basically settle back with their shareholders to move up to a larger company where there is efficiencies.
Right. So if we then agree, that it would be beneficial to the ecosystem to have more public, previously venture-backed companies here, what needs to change for that to be the case? There's certainly been a recent spate of pretty significant exits, many of which were private. They were acquired by local companies, Maker selling to Disney. There was Oculus selling to an out-of-town acquirer. What needs to change, in your opinion, at a local level, at a foundational level, to encourage and support and drive companies to stay the course, go public here in LA?
Well, part of it is having personnel. So, for example, one of the guys on Scott's team who helped them get public helped us get public. So he learned how to take a company public. Then
he's awesome, by the way.
That same person had the ability to take somebody else public. You also have greater awareness of people who've been through it. So some of the advice I got actually when we first went public, some of the best advice I got was from Demand Media, who had been public 6 months before us, and helped advise what we should be doing on the road shows. So having mentorship does matter. Having patient capital, because as you've said and many others have said, you want to wait till you're ready to be public. You don't want to be forced into it. And when VCs see that you could have a very successful exit via an IPO, they're more willing to wait instead of the shorter term sale, which obviously is the alternative exit.
Right.
I think that LA does not have the infrastructure like Wall Street is. I think San Francisco has it better, or Silicon Valley. I hope that within time, you'll have all these, advisors, board members, employees, CFO, general counsel, all those kind of infrastructure. But it's also an issue of supply and demand. I think the more public companies that stay public, the more of those people were attracted here. I mean, they're all following where the business is. If there will be more business, all those guys that, that help you finance and go to this stage will come here. I'm very optimistic. I see things here changing all the time for the best. And if anybody in the audience is interested in going public, you should ask one of us. I'll be very happy to provide, help you avoid the scars that I got,
I think the process of going public is a whole ecosystem, right? And I think that the more companies that go public in LA, the better and more robust that ecosystem will be, and the more that it will be able to support companies doing that. It's sort of even weird to say to go public or not to go public. I mean, there's no doubt that going public is sort of the symbolic American dream. And it matters to investors. It matters to partners. It matters to dealers in our case. It matters to employees. And we are all fighting for those resources. We're fighting for investors. We're fighting for people to come work for us and be passionate. And so when they're inspired by how the company's doing and they can keep score and they can see with transparent information how the business is doing, I think that's a very positive thing. And if, again, you have the ability to predict the business, you're a growth company and you can operate well, you should be public. You should be disciplined about how you get there. You shouldn't want to be public because it's the American dream, though. That is sort of what was happening in '99. And I think that set back LA quite a bit, right? There was just such an eagerness to be public, and that's really not the way to go about it.
Right. You mentioned '99. Let's talk about what is kind of the elephant in the industry, elephant in the room, is are we in a bubble? What are your thoughts on just the financing environment in general? Is it, if you're at a point now where you're deciding, should I go public in the next 12 months or should I, wait another 24 months? Do you have any thoughts on where we are? Maybe speak to your particular industries or categories.
Yeah, the auto business is booming. We are at an all-time historical record for car sales in the U.S. It's over 17.5 million units. I get asked all the time about millennials not buying cars, and it's like, well, somebody needs to tell the millennials not to buy cars because they're buying cars, and I really think that it's about the ability to afford a vehicle, and interest rates are low, the markets are good, employment is good, so all of the fundamentals are there, but yet everybody is saying the car business has to peak. It has to come down. It has to be a bubble. And sure, they're right at some point, but there certainly is no evidence that it's anytime soon. I think the more important issue, and certainly this is true for TrueCar, what's really intuitive from the outside is if the car business is good, TrueCar must be good. And that's really not the issue for us. We're a contrarian business. When times are tough, people want to save money more than ever. So when the car business actually struggles, we tend to actually gain market share and paddle through that. And we're such a nascent brand that we're able to really grow in those times. So I think that, bubble or no bubble, the issue is, does your business address a fundamental need and is it durable? And that's, that's probably a good way to look at sort of surviving an up or a down cycle.
Right.
So we're in the cloud software space.
Right.
If ever people thought there was a bubble, people think it's there. But that was true 4 years ago.
Right.
That was true 3 years ago. That was true 2 years ago. And it's actually less true today because the multiples have come down quite a bit. If you look at the companies that have been taken out for cash, so public companies that then were acquired by other public companies, these have been done at very high multiples, higher than the average multiple today for these companies. So the belief is we are no longer in a bubble, and there's plenty of opportunity for growth for these companies. And even at current multiples, if the businesses are able to keep growing as we are at Cornerstone, you have the ability to keep gaining market share and market cap along the way.
So when I was a student, my teacher said that he hates to make predictions, especially about the future. So what my role as a CEO is to structure our company for both. We are global. We acquire many companies outside the US. The dollar is strong. So it's very opportunistic for us to acquire in Australia, in New Zealand, in Europe. So we are taking advantage of that. Regarding the markets, we are just seeing strong demand. We are in the cloud business, so we are replacement technologies. And we are doing well there. We sound serious. We are 3 CEOs on the stage, but I can tell you, being a CEO of a public company, and I know that both Scott and I will agree, is fun. Because you work hard, and it's very easy to show the world what you're doing. If you're private, you have to chase this PR person to talk about your company. Here, you don't need to. You just perform well, they chase you, and you wake up in the morning and you read how good you are. So it's cool. I do recommend you to be public companies, you know. Just be successful, because otherwise, as I said in the beginning, you'll see it in the mirror that you are failing, right?
Or read it in the paper.
Right.
Read it in the, yeah.
I think that's a pretty good place to end. I want to thank you guys all for joining me up here. Thank you guys for listening.